My objective in this module is to provide background on the publicly traded financial instruments that will be in portfolios of most investors. So we're going to do this with an example from Apple stock, look at Apple, its stock, and its debt, and how an investor might hold those assets. As you're going through this module, it would be useful to have the two documents downloaded that are part of this module. The first one of those is titled Week 2 Terms. These are terms that will be discussed in this module, and you are expected to know these for the midterm and the final. It would be good if you just wrote the definitions of these following terms, and on the midterm we will have a list of terms, and some of those are included on this list, and you will have to define those. Also attached are Apple's financial statements ending in September 2014, so you might want to download these, leaf through those, and we will be showing screenshots of those Apple financial statements as we go through this module. Apple is an example of a publicly traded company. And a publicly traded company is one whose stock is publicly traded, often on an exchange such as the New York Stock Exchange or NASDAQ. In other words, the stock of that company is available to be exchanged on a readily basis amongst individuals. Publicly traded companies are regulated, and one of the regulators of publicly traded companies is the Securities Exchange Commission. Those regulations typically revolve around making sure that the financial reports of that company are publicly available and that all individuals, regardless of their affiliation with that company, have access to those information. That information includes annual reports, quarterly reports, current reports that are happening throughout the year, proxy statements, and additional disclosures. And the company is required to disclose items that could materially affect its stock price whenever those items become available to the management of that company. More information on what a publicly traded company is and its regulations are available on the U.S. Securities and Exchange Commission site. Here you see that site, and at the bottom of this page you see the address for that site. You can get to this also by Googling SEC, and this information will become available. Apple, like all publicly traded companies, makes its financial statements available to the public. Here you see one way Apple does that, and this, what you're looking at now, is a screenshot of Apple's financial information part of its website. Here you see the earnings releases, which happen quarterly. In 2014, they happened in January 27th, April 23rd, July 22nd, and October 20th. So we're coming up on the October release, which could cause its stock price to move, but those will be released again. Its next will be on October 20th. So those earnings statements, quarterly earnings statements, are available again from its website. Also available on its website, and you can see it in the blue box that's now highlighted here, are its annual reports. We are going to be looking at the September 29th annual report. You are now looking at the balance sheet from the Apple financial statement. This happens to be on page 47. The ending date of the balance sheet is September 27th, 2014. On that date, Apple had $231.8 billion of assets, and obviously assets equals liabilities and shareholder equity, so it also had $231.8 billion of liability and shareholders' equity. We are now zooming into a particular portion of the balance sheet, so we've cut off the asset portion, and now we're looking at the liabilities and shareholder equity portion. I am now going to highlight 3 items on the liabilities and shareholder equity portion. Those 3 portions are commercial paper, long-term debt, and common stock. The reason why we're zeroing in on these 3 is because those 3 are what are often held by individuals. We are now going to discuss those three in turn, and we're going to begin with commercial paper. Here is the definition of commercial paper, and this comes from Investopedia. You could get all of the definitions for the terms on that sheet from Investopedia or Wikipedia. But as you can see here, commercial paper is a short-term debt. Corporations typically offer these debt at a discount, which means that the par value or what it will pay at maturity is, for example, $100. The person's buying that would then pay a discount or something less than $100, and the difference then would be that interest on that short-term debt. Commercial paper typically is for less than 270 days, and the bottom part of this comes from the financial statement of Apple. As you can see, it had proceeds of commercial paper, this would be from 2014, of $6.3 billion. Investors typically do not hold commercial paper for a single stock or a single company such as Apple because the denominations simply are too big. Typically what happens, or the way an investor would hold commercial paper, or one of the ways, is through a money market mutual fund. The money market mutual fund would buy paper from Apple and other companies, and they would sell shares in that money market mutual fund to individual investors. So you as an investor could buy a share in a money market mutual fund, which may hold the commercial paper of Apple. We will be talking about commercial paper in the second module of this course, but here's an example again of how you might hold that through a money market mutual fund. The money market mutual fund may also be a money market exchange traded fund, and we will talk more about the differences between mutual funds and exchange traded funds in modules in coming weeks. We will now turn to debt, which again will be discussed more in the second module of the course, but debt are typically bonds. Here is the list of bonds that Apple has outstanding. You can see there from this list they give it for 2014 and 2013. There are various floating rate bonds, floating rate notes with floating rate interest rates, and fixed rates. You see the list there. And at the end of 2014, there were $28.9 billion of bonds that Apple held. Investors typically do not hold bonds of companies in their portfolios, but they would hold a bond mutual fund. Again, the bond mutual fund would buy bonds from Apple and other companies and then sell shares in that mutual fund to individual investors. The final item on the liabilities and shareholders' equity we will talk about are common stock. Common stock is the equity portion that an individual or others can hold. It's the residual claimant. Any gains in value flow to the common stockholders, and any losses also hold to the common stockholders. They are the residual claimants. They stand the most to gain or losses from changes in performance of the firm. The types of returns that an individual can get are dividends and also changes in the stock price of the firm. Here are the dividends declared by Apple. As you can see, in each quarter of 2014, it was a 47-cent dividend. In 2013, it was a 44-cent or a 38-cent dividend by quarter. Most companies, and Apple is an example of that, have a fairly standard dividend policy. They don't typically vary dividends much across quarters regardless of earnings. They set a dividend policy and then stick to it. Apple's dividends have been growing over time. The other part of the return for all stocks, or as far as the total return, is capital gain, and we're going to do a capital gain calculation here. I downloaded the Apple prices from Yahoo Finance. You see them listed here for September 27th, 2013 and September 29th, 2014. And you see I have highlighted with the arrow there that close. At the beginning of the year, it was $482 per share. At the end of the year, it was $100 per share. And now, if you're sitting here, you will think just by looking at that, or you may think just like by looking at that, that Apple had a poor year. Its stock price declined by $482 at the beginning of the year to $100 at the end of the year. In actuality, that would be a wrong impression, and there were two events that happened in the year that caused that to be a wrong impression. The first is that Apple declared a stock split, and that happened it was declared on April 23rd, recorded on June 2nd, and you can see there at that highlighted number we had a 7-for-1 stock split. At that date, each share that an investor would have held, if they held one share, now they would have 7 shares. The share split, 7-for-1, then resulted in a decline in price, roughly one stock on one day. If it's after the 7-for-1 split was 1/7. Here you're looking at a graph of what that stock split looked like. You can see clearly the date of that stock split. Again, nothing bad happened to Apple's stock on that date. There was simply a stock split. Companies often do those stock splits because their price of their stock is getting high, and this makes it more affordable for an individual investor to hold. The other item that went on was a share repurchase plan. Apple has been generating good earnings and has a lot of cash, and one of the things that they have been doing is repurchasing their own shares. So as Apple owns their own share or purchases back their own shares, the net impact of that is that the remaining shares have a larger proportion of the company's total return. The net impact of those two changes, stock split and repurchases, along with the dividends declared, are taken into consideration on the adjusted close. Here you see the adjusted close for those two dates, again the beginning and the end of the 2014 year. As described in last week's modules, we can calculate that total return. It was 48.4%, so Apple had an excellent year, returning a return of 48.4%. Current returns, and again we had 182 in dividends per share, was roughly 2.7%. I say that's about, I did an approximation here. We would have to have a bit more information, and the computation would become more complex, but it's roughly 2.7%, which means that during the past year about 45.6% or 45.6% of that 48.4%, 45.64% of it is capital gain. Total return, at least as we measure it in finance, is not the same thing as an accounting return. Here I'm going to highlight the differences in those. You're now looking at another part. This is page 53 of the Apple financial statement, and you can see there that it gives earnings per share. Those earnings per share, as measured by basic earnings per share, was $6.49. If you take $6.49 divided by the par value of the stock, you will come up with nothing close to 46%. And here, conceptually, is the difference between those two. Accounting returns are fundamentally looking backwards. They're looking at the financial statements, looking and prepared with GAAP, generally accepted accounting principles, looking at those statements and determining what earnings per share were. These are very critical measures of returns. We need to know what firms and others, particularly publicly traded firms, have done in the past. Total returns, however, are more forward-looking, and to understand that you have to think about what the price of that stock means. And those prices are actually, conceptually what they are, and we'll cover this again in future modules, is the expected value of future returns from that company. So they're forward-looking, they're taking expectations of future returns. So there is a linkage between accounting returns and total returns. If accounting returns come in below expectations, total returns, or the value of the firm, will decline, and total returns would decline. But accounting returns, again, are looking backwards, looking at what actually has happened and measuring what has happened. Total returns are the market's expectations of what future returns look like for that firm. When we see a price increase, market participants are believing that those returns have increased, and decreases mean the opposite. Another key idea is market capitalization, and I'm going to give you an example here with Apple stock on September 27, 2014. On that date, the price of Apple stock was $100.11 per share. There were 6,294,000 shares outstanding at that point in time. You could see that 6.294 million shares. You can see that listed on the balance sheet. At that date, that market, or the price of Apple stock, was $100.11. If you multiply those two together, you get the market cap, which was $630 billion. That $630 billion is the market assessment of the equity value of the firm. Note again that that is going to differ from what is shown on the balance sheet, which we can see there that total shareholder equity is $111 billion. The market cap is the market's assessment of that value, taking into consideration the future cash flows. Balance sheets are prepared according to accounting standards, and generally assets on those balance sheets as well as debt are at cost values, more or less nowadays. But they are not attempting to value the future of the firm, which is what the stock price represents. There are two ways an individual can, or typically holds, there's more than two ways that an individual could hold Apple stock, but the typical ways are through a stock mutual fund. The Vanguard 500 is one of those funds. That stock mutual fund would purchase shares in Apple stocks and other company stocks and then sell shares in the mutual fund or ETF to individual investors. Individual investors, as the bottom graphic shows, could own Apple stock as an individual stock. That's quite easy to do. You can do it electronically, but individuals could buy Apple stock as well. So there's two typical ways, either through mutual funds or ETFs or individual stocks themselves. Stock exchanges are important methods for transferring stocks from one individual to another. New York Stock Exchange and NASDAQ are two of the bigger ones in the United States. There are other international stock exchanges as well. But those are a way for individuals, investors, and other entities to trade stocks. As you're watching prices on these stocks through these stock exchanges, it's important to remember that those stocks typically are not being bought and sold by the individual companies themselves. Apple typically isn't going out and buying and selling its stock on a daily basis. They obviously have some repurchase plan, but it is mainly buying and selling of stocks amongst individuals and entities that own that stock. So one entity wants to sell Apple, another entity wants to buy Apple. The way that exchange can happen is through a stock exchange. When we're looking at those prices on those stock exchanges, they are measuring those exchanges between entities or individuals. The way performance of the stock market or specific elements of it are measured is through stock indices, which isn't one stock but multiple stocks. Two of the broader indices that are in the United States are the S&P 500, which we are tracking as part of our asset tracking. Another similar one to that is the Dow Jones Industrial Average. What these indices do is measure the value of those stocks in aggregate, and the way the weighting is done is they take each stock's market valuation relative to the total valuation. That is the percent share that individual stock gets in the individual or in the indice. So, in summary here, what we've done here is provided background on publicly traded companies and the typical instruments that individuals would hold. In Module 1, we're talking specifically about stocks. Module 2, we will deal with bonds and commercial paper. I would also suggest you take a look at that term sheet, come up with the definitions for each one of the terms, and be prepared to define those on the midterm exam.